It's Thursday, December 1st. You're watching today's Daily Market Comment by Haralabos Pisuros. I'm Christina Marujos, and thank you for joining us here at xam.com. The US dollar tumbled against all the other major currencies on Wednesday and continued to drift south today after Fed Chair Powell failed to sound as hawkish as expected. The Fed chief confirmed the narrative that the committee could slow the pace of its interest rate hikes as soon as December, adding that the fight against inflation was far from over. He also said it remained an open question how high interest rates will need to rise to control inflation and how long they will need to stay at a restrictive level. Market participants today adjusted their expectations of rates to peak at around 4.9% in May. What's more, despite Powell saying that they are hoping not to over-tighten because cutting rates is not something they want to do soon, investors continue to price in nearly 2/4 point cuts by the end of the year. This likely indicates that the market stubbornly sticks to its guns and avoids altering its view when Fed officials push against it. With the market staying convinced that the Fed may be forced to cut interest rates towards the end of next year, the dollar could continue sliding for a while longer, while equities may extend their latest recovery. Yesterday, all three of Wall Street's main indices gained more than 2% each, with the interest rate-sensitive Nasdaq rallying 4.41%. Yet the discussion of a full-scale bullish reversal remains premature. Although weak U.S. data add to the notion of a slower rate path hereafter, a damaged economy is far from a positive development for the stock market. Thus, in case the economic outlook deteriorates further, the market impact of weak data on equities may well change. The next big test for dollar traders and equity investors may be the U.S. employment report for November, due on Friday. Although forecasts point to a decent report, a negative surprise could well extend the dollar's downside correction and the recovery in stock markets. Ahead of Powell's speech, investors got busy adjusting their bets with regards to the European Central Bank's future course of action after Eurozone's headline inflation slowed by more than anticipated. Markets are almost convinced that a 50 basis points hike by the ECB may be the wisest choice. Yet that was not reflected in Eurodollar at the time of the release. Investors maintain the view that the ECB may need to deliver more basis points worth of hikes than the Fed henceforth, and such pricing may keep Eurodollar under buying interest for now. This was a Daily Market Comment here at xam.com.